Derivatives, evolution, benefits, and types. Derivatives are financial instruments whose value is derived from an underlying asset. Don't get confused, as it could sound initially like a jargon. For example, let's take a farmer who owns a paddy field. He forecasts the price of rice to fall next year, that is in 2021, by June. To safeguard his interests and to avoid incurring heavy loss on his paddy cultivation, the farmer strikes a contract, a written one, with a rice trader. Based on the contract terms, in June 2021, on the 10th day, the farmer agrees to deliver 1,000 kilogram of rice at rupees 15 per kilogram. This way, the farmer is protected from future price fluctuations that could adversely affect the price of rice, resulting in a price fall below rupees 15 per kilogram. Here, the contract signed is called a derivative and the underlying asset is rice. Let's now look at how derivatives evolved through the history. In 600 BC, a Greek philosopher, Thales of Miletus, became the first derivative trader, and that was in olive oil. In 1730, rice was traded for future delivery in Osaka, Japan. In 1848, the Chicago Board of Trade (CBOT) came into being. In 1875, the Bombay Cotton Trade Association started futures trading. In 1919, Chicago Mercantile Exchange formally came into being, and this got renamed as Chicago Mercantile Exchange from its predecessor, CBOT. In 1952, the Government of India banned cash settlement and options trading. In 1972, the International Monetary Market came into effect, and this was for futures trading in foreign currency. In 1999, use of interest rate swaps was approved by the Reserve Bank of India. In the year 2000, futures trading in India came into being and on Nifty 50 index. In 2001, trading in BSE Sensex options became a possibility, and now you can either trade in stocks as a commodity or in indices. The biggest trade or derivative exchanges include the Chicago Mercantile Exchange and Chicago Board of Trade, the Korea Exchange, and Eurex. This is from a global perspective. The regulatory framework in India is based on the L.C. Gupta Committee report and the J.R. Verma Committee report. Forward Markets Commission, FMC in short, is the chief regulator of commodity futures markets in India. There are certain benefits attached to derivatives. Hedging or mitigating risk. Since the value of the contract is intrinsically linked to the underlying asset price, it can be used to insure against losses caused by unexpected price drops or hikes in the future, determining the price of underlying assets. Derivatives are often used to determine the price of the assets and also, to a very large extent, contributes to price stabilization of commodities. Speculation and arbitrage. Derivatives can be used to hedge risk as well as acquire risk. Speculators can buy an asset at a low price in the future based on a derivatives contract even when the price rises in the future. They can also sell assets at a high price in the future when market prices are actually going down. So they tend to benefit from the change in price across two different instances, and that is called arbitrage. Increasing market efficiency. A trader can replicate the payoff of the assets using derivative contracts. Prices of the underlying assets and the contract tend to remain in equilibrium, negating arbitrage opportunities. Access to different markets and assets. Individuals and organizations can gain access to unavailable or otherwise hard to trade assets and markets. Companies can borrow money at favorable interest rates rather than higher rates in the current market. There are tax benefits also. There are derivatives like equity swaps where an investor can get steady payments based on the London Interbank Offered Rate, LIBOR, while avoiding capital gains tax. Derivatives are an important part of the global financial markets. The gross market value of OTC over the counter derivatives alone in 2018 stood at $10 trillion, but they do have counterparty risks, price, and systemic risk associated with them, which are very important to consider before entering into any derivative agreement. That's all about the evolution and benefits of derivatives. If you have any questions in understanding the theory part or would like to master the art of trading in derivatives, please reach out to me. If you haven't subscribed yet to College Guru 2020, now is the time. Thank you and happy learning.